You spend $500 on a $100,000 prop firm challenge. You backtest your strategy for weeks. The data is solid. But 48 hours later, your account is completely wiped out. This usually begins with 3 consecutive losses. Your heart starts racing, your nervous system takes over, and on the 4th trade, you double your lot size to reclaim what you lost in a single swing. This collapse is the result of a specific mathematical error. When the risk per trade is too high, a standard string of losses triggers a geometric trap that is nearly impossible to escape. While retail traders focus on the potential for profit, professional fund managers prioritize capital preservation. Adopting this institutional focus on risk is the first step toward maintaining a funded account over the long term. High-risk trading is statistically fatal because of the asymmetry of loss. In financial markets, the effort required to recover capital is significantly higher than the effort it took to lose it. This chart illustrates the 50-100 trap. If your account drops by 10%, returning to your starting balance requires an 11.1% gain. Because your remaining balance is now smaller, every dollar you earn represents a larger percentage of your current equity. As drawdowns deepen, the math becomes increasingly punitive. If you lose 50% of your account, you need a 100% return on your remaining capital just to reach break-even. This exponential curve is why risking a high percentage of your balance is a mathematical death sentence. Professional traders use the 1% rule as an absolute ceiling to ensure their drawdowns remain within a manageable range. Opening every trade with a static, standard lot ignores the reality of market volatility. To trade with precision, your position size must be a variable, not a constant. This universal formula keeps risk identical across trades. Divide the dollar amount to risk by your stop loss multiplied by pip value. Risking $1,000 on Euro-USD with a 20 pip stop yields 5.0 lots. A 50 pip stop on GBP-JPY drops it to 2.17 lots. Your downside remains exactly $1,000 in both cases. Using volatility-adjusted sizing is the only way to ensure your capital is protected, regardless of how aggressively an individual pair moves. Prop firm challenges operate under specific mathematical constraints that most traders ignore, specifically the concept of functional capital. On a $100,000 account with a 10% maximum drawdown, your actual trading capital isn't the full balance. It's the $10,000 of room you have before the account is closed. To manage this, many pros use a 0.5% pivot. If your account dips 3 or 4% below the starting balance, you have your risk. This slows the rate of loss and gives you more opportunities to find a winning trade while under pressure. You must also account for correlation. If you risk 1% on USD-USD and another 1% on GBP-USD simultaneously, a sudden spike in the US dollar will likely hit both stops. In that moment, you haven't taken 2 independent trades. You've taken a single 2% risk on the dollar. Success in a prop firm environment requires treating the account as a constrained mathematical sandbox. In this setting, defending your functional capital is the primary requirement for survival. Trading is a game of probabilities. Even a strategy with a high win rate will eventually produce a statistical cluster of losses. In a sample size of 20 trades, it is mathematically normal to see 8 or even 10 red dots in a row. Most traders abandon their plan during these clusters because they fall for the gambler's fallacy, the belief that a win is due after a series of losses. The market has no memory. Every trade is an independent event. By adhering to the 1% rule, you maintain the staying power to survive these inevitable cold streaks. A string of losses only puts you in a small, manageable hole, allowing the law of large numbers to work in your favor. Managing risk at the macro level allows your statistical edge to manifest over time, reducing the emotional weight of any single trade outcome. When your risk is controlled by precise math, your physiological response to trading changes. Keeping the dollar amount low helps prevent the brain's fight or flight response from overriding your logical decision-making. A loss becomes a data point rather than a threat to your lifestyle. When the risk is small enough that it doesn't hurt your wallet or your future, you gain the freedom to execute your plan with patience. You can automate this discipline by using the FXNX position sizing calculator. It ensures every trade you take is mathematically sound and consistent with your drawdown limits. Stop gambling on oversized lots and start managing your capital logically. Download the Prop Firm Risk Management Spreadsheet and join thousands of professionals trading on NX1 today.